Bala is with us now of cashthechaos.com. Tuesday afternoons. It's Jay Bala chat time. Jay, good to have you here. Good afternoon. How is the view evolving, Jay? I mean, you were cautious to pessimistic. I mean, if that's the scale. And I want to ask you, where are you on that scale now? Tilting towards pessimistic or, just cautious?
Yeah, good afternoon, Prashant. Thanks for having me on the show. I'm still pessimistic on the market, but the markets are getting into a very complex correction. It's pretty obvious to me that it's not start of a new trend to the upside. So what I had, my view still continues along the same lines. The market had to complete a move past 17,917. At least one tick was above that required for the market to complete a pattern. The market has done that. It's come to 17,954. I think a break below 17,652 would signal that the next leg of the down move has started. So we are waiting for the markets to play out in the next few days.
Okay, so you're retaining a negative call, Jay. Take that, 17,652, and then you're expecting another leg down. Okay, let me ask you, what's looking weakest in the market to you at this point in time? Is it the banks? Is it which set of stocks?
Yeah, that's right. It should be. The banks, the range is more compressed than that of the Nifty. The focus on the banks is negative, and SBI and ICICI the main contribution for this. And the resistance for the banking index is about 42,280. Once it goes below 39,170, I would expect an acceleration towards 37,000 and 35,000. So the price action for SBI and ICICI are saying that they are facing considerable amount of resistance.
All right. Hi, Jay. Good afternoon. Jay, this cautious view on the Nifty has worked so far. The last few weeks you've joined us. Well, it's, we have not been past the 17,950 odd. But what would negate this cautious view for you? If we break what level on the upside? So that's the first part. And the second part is, what's your view on the IT index? The NASDAQ went through a bit of a lull. The IT index as well did cool off a little bit. But today it seems to be coming back in style. Your view on both these two?
Yeah, Nifty IT is one of the indices I've been bullish on, but I've not been. Its markets haven't given me a clear signal if that has to be taken forward as a medium-term bullish sign, or if I've treated it as just a short-term bullish thesis, and I've been bullish on specific names like Persistent and HCL Tech. And Persistent has come near record highs now. The worrying part is the heavyweights like Infosys, Wipro, and TCS. They are not giving much of confidence. So quite obviously, the Nifty IT index is not going as much as it should. But as long as 29,500 is protected for the Nifty IT index, I think it's okay. When it comes to the negation point for Nifty, I don't expect the 18,201 level the markets clocked before the budget started, that level to get taken out. But that is not the invalidation level. But I'm saying that itself will offer a resistance. But what would make me uncomfortable on my bearish thesis? The markets were to get above 18,300 to 18,350. It's a rough figure there. If it crosses that, then I'm probably going wrong. But I don't think 18,200 itself will cross.
Jay, any thoughts on Reliance Industries? That's made a big up move today.
Yeah, it's on a it's sort of a middling move. It's extreme short-term bullish, but the medium term is not that encouraging. The stock should not have closed below 2,400. It's sustained below 2,400 for several days. But I would look at short-term play for something like a swing trader. So something close to revisit of 2,400, 2,550. I don't see it going much beyond that. But it may not do much. It could just go sideways, and that itself will be negative contribution for the indices. If Reliance doesn't contribute, the market would lack firepower.
Jay, I just want to revisit your call on the US 10-year as well. I know you've been maintaining that negative view. You're looking at yields quite carefully. Given the whole context, it's been really pushing that, I think 3.7, 3.74 kind of a handle. What are the levels here you're looking at?
Yeah, I think the bond markets have given a very important signal. The bond markets are seldom wrong. So, I think the march is on for the next leg up towards 530 bips. And, if you look at the bond ETFs, which tracks the bond prices, they have broken below a trend line, whether you look at TLT or IEF, which tracks the 20-year bond or the 7 to 10-year bond. They have broken below a trend line that started the move from September. So they are also signaling that, the next leg up for the bond yields are there. And from I've mentioned this before, from a 24 months perspective or slightly longer, I'm expecting the 10-year bond yields to touch about 700 bips. This is a bubble that burst. It's a 40-year bubble that's been burst. So, I put out a note sometime back in May or April last year that, the 40-year trend line has been broken. So, the
Jay,
has got a lot to go.
Jay, I'm just trying to reiterate this and digest what you're saying. You're saying this is a 24-month view, but this is the US 10-year we're talking about. You're saying 7%?
That's right.
Okay. Prashant?
He's got company, actually. I was speaking with somebody, and it's becoming a little mainstream. Actually, I should not say mainstream. It is not mainstream. The view is not mainstream. But Jim Walker, I don't know if you guys remember.
Yes.
Ex-CLSA was the economist.
Yeah.
So the IIFL investor conference is going on in Mumbai today. And he made a presentation this morning where he said that the Fed funds rate, according to him, should get up to 6% and maybe even more. So he said it to a room full of people who
and you're talking about
were optimistic.
And this is today, early in the morning today. So I was talking to somebody who was at the conference, and he said that it was people were a little baffled, and I think there are also now people, mainstream investment banks, etc., who are starting to talk about what could rates get to 6%, more than 6%, and things like that. So Jay has got company there. Although Jay's view, of course, is based on charts, and we've actually put that chart, that 40 years, starting 1989, right, Jay, where when. It was a one-way decline, and it's broken out, and we are so let's see how high it goes. Jay, of course, is talking about market interest rates, and Jim Walker was talking about the Fed funds rate. Yeah.
I think I should take Nigel's advice. If things are going, bonds are going to 7%, I don't know what Armageddon is coming. I think I should go and celebrate Valentine's Day.
But Surabhi, the point is that rates will only go so high if growth is so strong, right?
Yeah.
If growth
that throws the recession argument out of the window completely.
So there is no hard, as someone said, I think there's no hard landing, soft landing. Maybe there's no landing. You continue to do well, which is not a bad outcome at all. Jay, I don't know if you want to add to it briefly if you want to. Go on.
Yeah. An interesting part, Prashant, is that the 40-year before 1980s, there was an uptrend for the bond yields. So it's again it's dividing quite in equal proportion. So for a 40-year bond rally, I don't think a 5-year decline is too much to expect.
All right. Jay, thank you very much. It's always interesting conversation. Appreciate you joining in with that perspective. Jay Bala of Catch the Chaos with that perspective. 17,927 is where we are at. So we are up 150, 160 odd points. There is a bit of plateauing which has happened post, actually since we started the show at 2:30. We'll take a break. We are back. We'll get you what's happening in dealing rooms with Nimesh, who picks up all the chatter for you. And of course, our BTST calls with technical experts.